The problem with this is that we have squandered through idiotic fiscal and monetary policy. We're broke. When you devalue the dollar, you do it in rising gold. What is Tether doing? It's what they're all going to do. They're going to take that Treasury, the interest that can't be passed on, which suppresses interest rates on the front end of the curve, and they'll take that interest and they'll buy gold. Gold goes higher, 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 higher. You don't have to revalue it. James Rickard says 24,000. Mike Maloney says 10,000. The higher the price of gold goes, the lower the value of the dollar goes. And that is why, bigger picture for you all, if you save in dollars, you're going to go broke.
Until recently, most people still believed the United States could financialize its way out of anything. Andy Schectman argues that illusion is ending. The real issue, he explains, is not politics or headlines. It is production. A nation that no longer manufactures, that outsources its industrial base, and replaces tangible output with financial engineering, eventually runs into a wall. The central question, in his view, is simple but uncomfortable. How do you rebuild manufacturing when the country is drowning in obligations, dependent on imports, and structurally tied to a strong currency that prices its own labor out of competition? This is not presented as drama. It is presented as arithmetic. He connects this to a deeper structural flaw, the burden of being the global reserve currency. When the world must accumulate dollars to transact, persistent trade deficits are not an accident. They are a requirement. Over time, that dynamic hollows out domestic industry. Foreign nations accumulate dollars, recycle them into U.S. debt, suppress yields, inflate asset prices, and create the illusion of prosperity. Consumers enjoy inexpensive imports. Investors celebrate rising portfolios. But beneath that surface, productive capacity migrates elsewhere. The wealth effect masks the erosion of industrial strength. Schectman then shifts the focus to gold. For years, he maintains, pricing mechanisms in paper markets kept precious metals contained to preserve confidence in bonds and currency stability. Yet something changed. Central banks began demanding delivery. Large traders followed. Physical metal began flowing back into the United States in unprecedented size. Not retail speculation, institutional positioning. The signal, he suggests, is not price momentum, but physical acquisition. From there, he outlines what he sees as a strategic shift. Emerging monetary legislation tied to digital settlement systems creates structural demand for short-term government debt. The interest generated within that system, he argues, can be redirected into hard assets, particularly gold. As gold rises, the dollar weakens in real terms without a formal declaration. No official reset, no dramatic announcement, just a gradual repricing through markets. A softer currency improves export competitiveness, addressing the very manufacturing dilemma that started the conversation. In this framework, rising gold is not a coincidence. It is a mechanism, a controlled devaluation without calling it one. And if that process accelerates while physical demand continues to tighten supply, the implications extend far beyond metals markets. Because if confidence shifts from paper assets to tangible reserves, and if currency strength becomes a liability rather than a symbol of dominance, then the real question is not whether gold rises. The real question is what happens to those still saving exclusively in dollars when the repricing is complete. Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters. I'd love to hear from you in the comments.
Let's start with the facts. We're 200 trillion in debt, you guys. A trillion seconds ago was 31,688 years ago. And we're 200 trillion in debt. Everyone says 38 trillion, but what about Medicare and Medicaid and Social Security and government military pensions? And how the hell do you pay off 200 trillion in debt when you don't make anything anymore? We've offshored our manufacturing for years. It's something called Triffin's dilemma. I'm going to talk about that in a second. I said we're uneducated. We're basically stupid. All right, it is. 60% of the United States has a literacy rate below that of the 6th grade. Now you tell me, is that an educated nation? Don't think so. And guess what? So we're broke, we're insolvent, we don't make anything anymore, uneducated. And Kristalina Georgieva, the head of the IMF, says, Guess what's here just in time to kneecap everything else? That's called AI. It's going to take out 50, 60% of the incoming jobs. My son, who works for me now, was getting paid 80 grand a year to work at Price Waterhouse to analyze the real estate investment trust balance sheet. Now, what the hell does Price Waterhouse need to pay a kid 80 grand for when AI says, I'll do it for free? Boom, done. Think about that for a minute. Where are the jobs going to go? It's called a K-shaped economy, where the rich get richer and the poor get poorer because the efficiency that comes at the highest level, the business owners who are way more efficient, comes at the expense of millions and millions and millions of jobs. Makes me think of Klaus Schwab wasn't such an idiot after all. You'll own nothing and be happy. Think about this. This is not bullshit. This is real, okay? This is real. AI says 50 to 60% of entry-level jobs are gone in the next few years. And we don't make anything, and we're dumb. Triffin's dilemma. I don't know if any of you know what Triffin's dilemma is, but it is the problem that we face right now. Triffin's dilemma says that if you are the reserve currency, you will always run trade imbalances. Why? Because the world needs more dollars than we can give them through trade alone, period. And so what happens is countries have to buy our dollar in order to buy things around the world, from credit to oil and everything. And over time, as they continue to buy our dollar by selling their currency, which means their currency gets weaker against ours, that inequity grows and grows and grows until manufacturing says, well, I can go to Cambodia, Vietnam, China, you name it, I'll go there and I'll sell my stuff at a lot less money. And we at the top will make a lot more money. And when you do this enough, what happens is these countries get flooded with our dollars, our trade imbalance, right? And instead of taking those dollars and doing nothing with them, they put them into U.S. Treasuries. And that keeps interest rates low. So what has Triffin's dilemma done for us up until now? It's kept the world buying our stuff, which means, taking our dollars to buy their stuff, which means the stuff we bought at Walmart and Target, we got really cheap. And it means the interest rates, because they continually buy treasuries, have been very low. So our asset prices, our house, our 401k go way up. We feel rich. It's an illusion. And the problem with this is that we have squandered through idiotic fiscal and monetary policy. We're broke. And we've kind of screwed the pooch, if you will. And I think President Trump, or someone who got to him, understands this. I'm going to try and show you what I mean and connect the dots by this. All right, so all of you see what gold is doing. It's pretty crazy, right? And I want to tell you that every one of you in here is the pimple on the elephant's ass. Every one of you. The elephant out there, they don't know gold. They don't know gold if it fell on their foot, right? The people who have been buying this, and you represent such a small, can any of you talk to your friends for 8 seconds about why to own gold? No. Are any of you like me, where my wife says, if you open your mouth when we walk into Thanksgiving dinner, you're dead? Right? Well, that's me. So people don't get it yet. The official sector, that's the central banks. The central banks. I've been saying that for 5 years, right? If you've been listening to me. Well, now who is it? The most well-informed traders on the planet, and the wealthiest, are blowing up the COMEX exchange. We have become net importers of gold for the first time. We've been net exporters. Why is nobody asking who the hell's bringing in billions and billions and billions and billions and billions and billions of dollars of gold every single month for the last 16 months? Where is the mainstream? How about Jim Dumbass Cramer? Where is he? Why is he not asking this? Oh, gold's oversold, overbought, it's a top. That's what they all say, right? How about silver? Same thing. That's what they all say, but what happens? Well, let's see, every month, billions and billions and billions and billions keep coming in. That's all you need to know, period. Nothing else. I could get off the stage right now. The most well-informed traders in the United States have been blowing up the exchanges. Blowing them up with importing gold into the COMEX market. Who's standing for delivery? How about silver? The largest delivery in the history of the COMEX market for a December happened in December, right? After it was a bought market, right? They raised margins to knock it down. Did that matter? No, it didn't matter. 68 million ounces were delivered. And so far this January, which isn't even a primary delivery month, over 40 million. Who's taken possession of 120 million ounces of silver in the last 40 days? And better yet, why does no one say anything about it but me? Ask yourself, a mint box of Silver Eagles is 500 ounces, weighs 42 pounds. Who just bought 120 million ounces, y'all? Do you think that has anything to do with the fact that the U.S. government just classified it a critical mineral? I don't know. Or how about the fact that they are now going to put state-sponsored price floors under it? I don't know. Or maybe now that they have just passed or floated a bill to create a strategic stockpile? I don't know. Well, that's silver. The same thing is happening with gold in spades, but nobody knows it. Well, if they listen to me, they might. But no one else seems to get it.
And this is where the currency side of the equation quietly begins to reinforce everything unfolding in metals. For months, markets have assumed a controlled path for rate cuts, gradual, measured, predictable. But Andy argues that assumption may be far too comfortable. A leadership shift at the Federal Reserve introduces a new variable, and with political pressure building to reduce borrowing costs, the possibility of deeper and faster easing cannot be dismissed. If policy moves more aggressively than expected, the dollar's yield advantage begins to erode. That shift matters mechanically. When U.S. rates fall relative to the rest of the world, foreign investors increase currency hedging on their dollar-based assets. Hedging flows create steady selling pressure beneath the surface. At the same time, fiscal concerns and lingering trade tensions have already weakened confidence in the long-term trajectory of the currency. Andy notes that while short-term rebounds are possible if economic data surprises to the upside, structural positioning suggests the dollar's strength may be living on borrowed time. This is not about dramatic collapse scenarios. It is about compression. When rate differentials narrow and global capital adjusts, currencies reprice quietly at first, then persistently. And if that repricing unfolds alongside tightening physical markets elsewhere, the consequences will not remain confined to foreign exchange. They will spill directly into asset classes that respond most aggressively to monetary weakness.
All the gold's been reshored. You now have a vehicle to create synthetic demand for the Treasury instead of organic demand up to 90 days. Keeps the front end of the curve low to stimulate borrowing and all sorts of other nonsense. And the interest behind those treasuries, anytime money moves, whether you buy a pack of cigarettes or a new villa, it's tied to it, to short-term treasuries. That interest rate stays with the issuer. What is the issuer doing? Buying gold. Gold goes up, dollar goes down. You can sell your manufacturing, but how do you get manufacturing back to the United States? That's plan B. How do you get it back? All right, Judy Shelton. Anyone know who Judy Shelton is? Great. Judy came onto my show twice, once with me and once with my co-host Michelle McCory, who's not here, and we're very happy to have Michelle. And she was Trump's nominee to run the Fed in 2016. One of, if not the most brilliant human beings I've ever had the pleasure of talking to. She said to me, Andy, and by the way, she said this in her best-selling book, Good as Gold. She says it all over her Twitter or X page. Andy, in no uncertain terms, President Trump told me when I was part of the transition team that on July 4th, 2026, this coming July 4th, it is the biggest day of his presidency. It is the 250th anniversary of the United States. He is going to peg the back end of the gold market to gold. Think about that for a minute. The front end of the curve is driven lower through synthetic demand where the interest is kept and put into gold, which goes higher. Bo Hines is the CEO of USA Tether, the primary benefactor of this, but JP Morgan and all these other banks and Visa and MasterCard, they will all do what they are requested to do because they will all benefit massively from this deal. The gold then gets sold to the Treasury. Now, if Judy is right, and she says, look, they're going to issue even a 50-year Treasury with maybe 1% interest, but a 5, 10, 20, and 30% or 30-year bond, 5, 10, 20, and 30, zero interest, zero coupon, which means it's redeemable in gold at the end. So the more stupid you are with fiscal policy and irresponsible you are with monetary policy, guess what gold does? It goes higher and higher and higher. And the Genius Act says gold's going to go higher and higher and higher. So you sell a bond for 20 years out for $20 million worth of gold. Today at $5,000, that's 4,000 ounces. What is it at 180,000, like Van Eck says, in a few years, when it's become obvious that we are no longer... What are all these countries doing in the BRICS that I've been talking about for 6 years? They're trading their own currencies over Enbridge or SIPS, the Cross Interbank Payment System, and they're settling imbalances in gold. Now, I don't have enough time. I have 1.5 minutes left here, or I'll go deep into that to support this. But here's the bottom line. If you sell a bond that is redeemable for 30 million or 40 million or 50 million in gold, redeemable in gold, zero interest rates, zero. That means you bring back your manufacturing at zero interest rates. No upfront borrowing costs. You build it out. And if the Genius Act keeps pushing gold higher and higher and higher and devaluing the dollar lower and lower and lower, guess what? You now have manufacturing here, and you can sell it at a wickedly low price because the dollar just collapsed. That's what they've all been doing to us. And you give your children a future, because our children and our grandchildren are flat out screwed if we don't. Flat out. How do you bring back manufacturing? How do you sell it to the world? In a devalued dollar with no upfront borrowing costs, and you pay back that bond in a fraction of the gold, 1/300th if Van Eck Funds is right, 1/300th of the cost today in 20 years or 30 years or whatever the duration of the bond is. What I'm saying to you is that we literally have no choice but to do this. And I don't have more time, or I would sit and go deep into this, but I just want you to think of this flat out. 30 more seconds, and I'm sorry for whoever's next. 30 seconds. If we don't do this, it's game over. This gives us the ability to bring back manufacturing, sell our products at a wickedly devalued dollar, and use gold as the key to all of this. The higher the price of gold goes, the lower the value of the dollar goes. And that is why, bigger picture for you all, if you save in dollars, you're going to go broke, so help me God. And if you are not a contrarian, you're going to be a victim.
Whether you are thinking this is just another policy cycle or something far larger, the next phase may appear calm on the surface, even optimistic. Yet beneath the headlines, the very structure of the financial system could be quietly shifting in ways that most portfolios are not prepared for. The future may not unfold as a sudden dollar collapse, but as a slow erosion of purchasing power hidden behind soaring asset prices. Gold could climb into ranges once thought impossible, while silver experiences violent moves that redefine historical norms. Long-term bonds may be redesigned to manage mounting debt, and currencies allowed to slide strategically, restoring competitiveness and easing systemic pressures. Headlines on economic growth and reshored manufacturing will dominate, but the true driver will be a recalibration of value, a deliberate weakening of the dollar to rebalance trade and absorb liabilities. In this scenario, those holding cash or waiting for conventional stability could face real losses, while positions in scarce, tangible assets will gain immense advantage. Once confidence shifts from paper to physical stores of value, the adjustment will accelerate quickly, leaving latecomers struggling to catch up. The critical question becomes, is the world entering the early stages of this financial reset right now? Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.